Are you sitting on a large IRA or 401k balance and still contributing? Here's the thing, sooner or later, the IRS is coming to get its take when you try to withdraw money. The Trump tax cuts, as it stands right now, are set to sunset at the end of next year. So I have to wonder, how does that affect someone who's in the middle of doing an IRA to Roth conversion or maybe considering making a large withdrawal from their 401ks?
Well, over the past 30 years, helping so many people that are close to or in retirement time, what you find is that one of the biggest assets that they own is either their house or their retirement account. And, for decades, I think the conventional wisdom was to save and invest in a tax deferred retirement vehicle because your tax rates would be lower when you retire. And I don't know about you, Dave, but of all the people that we've helped over the years, it seems to me that, most of our clients that are retired are spending the same, if not more income. They're traveling with their family. They're doing the things that they wanted to do. Some of them are, picking up a secondary home. And, for people that are savers, taxes are not usually lower. In addition to that, you saved a little bit of money in taxes to pay money on what's now a much larger balance because of the compound growth of that account. And then in addition to that, right now, what you have is you have the issue of the out of control spending on Washington and the fact that, we've spent ourselves into some massive debt problems that Republican or Democrat, it doesn't matter. Somehow they've got to figure this out and higher taxes, and your retirement account could be in their crosshairs for higher taxes. And so in my opinion, it's what we talk about here at America's Retirement Headquarters, which is our retirement team action plan. I want to share a story with you of some people that recently came in from an event that we did. Let's just call them Mike and Lori. And, in Mike's situation, he just recently retired. Lori had retired a couple of years ago. Mike is getting ready to turn 65, and Lori is a little bit younger than him. So he retired earlier this year. He needed to kind of help figuring out, navigating things like his, Medicare enrollment, what should he do with his wife's health insurance pre-65. And the big reason that he came into the office was because of the fact that he's got about $2 million saved up in tax-deferred retirement accounts. So Mike's a great example of a saver. He put money aside. He did what he was supposed to do, a good steward of his money. He's built up this big nest egg, but now he's thinking, well, now that I'm retired, it's a big tax bomb to take this money out. And so even in his situation, what he was looking at doing is he was considering the options of an end-of-the-year Roth conversion. And, for those folks that are listening, if you have more than $250,000 saved up in your retirement account and you would like a complimentary 2024 tax roadmap, now is an optimal time to get that taken care of. In fact, if you're one of the listeners from our radio show, or if you're watching this on YouTube or one of our podcasts, and you're one of the top 5 callers that call in and have more than the $250,000, we would be happy to give you that complimentary tax roadmap. But in their situation, the end goal, I think, for everybody is to try to get as much money over to the tax-free category as possible. And, the bottom line for Mike and Lori, the same would be true. But it's not as easy as just looking at doing a Roth conversion. So think about the moving parts that they had in their situation. First of all, he's retired earlier this year, but as he told me when he came out to the Economic Summit a week or two ago, he just got an offer to go back to work as a consultant. So now he has an opportunity to go back and work a little bit more on his schedule, but still get some really good income as a consultant. His wife's getting health insurance under the Affordable Care Act, so they had submitted what they had felt their income was going to be for this year. The problem is when they file their actual tax return next year, if they do the Roth conversion, if he takes some more income from consulting work, they could lose the tax credit that they had, and all of a sudden when they go to file their taxes next year in April, the government could ask for all of that credit back. And, if they got a credit of $1,000 a month, that's a $12,000 tax bill that could be an unexpected shocker that you find out when you go meet with your CPA or accountant. Now, the other thing is he had decided to turn on Social Security. So like many retirees, he thought, well, I'll just start collecting Social Security when I retire. He had already turned in his paperwork prior to getting this offer. Well, you take that income and it also factors into Social Security taxation. In looking at a situation, that there definitely can be some strategies. And again, the bottom line is, as I think Mike and Lori, and I think you as a listener, you need to work on getting the government to stay away from your money. But simply doing a Roth conversion without strategic and tactical planning could be a mistake. This is an area where you want to talk not only to a financial professional, but you want to run the numbers, maybe even look at doing a mock tax return before year end with an accountant or CPA. And it's always important to do that before you make important financial decisions. But, those of you that have high balances in retirement account, the government is not going to be your friend. In fact, if Mike and Lori ultimately leave that money to their children, there's money left over for high balance retirement accounts. I'm telling you that, in my opinion, is another area that could be a nightmare for our family. So the retirement team action plan, and included with that complimentary roadmap, would help out, I think, addressing the issue of taking a look at Roth conversions before end of the year.
I think a lot of times, too, when you look at, not specifically in Mike and Lori's situation, but other folks, I have clients who basically say, gee, what I have, my bills and my level of debt, which is basically zero, I can live on my Social Security. And good for those folks. However, when they get to 73 and have to start taking required minimum distributions, that becomes an eye-opener. So when you start looking at a person that's either newly retired or going to consider retiring shortly, it's worthwhile to have a discussion about, should we turn on a trickle of income? Should we start the food chain, the pay chain moving for them prior to when the required distributions kick in, so that the impact of these so-called tax bombs isn't a maximum impact? So I think for a lot of people, they should take a hard look at, does it make sense to turn on some income early on in the retirement process? If you have Roth assets, you don't ever have to take a required distribution from that. Mm-hmm. But like I said, every situation is different. Mike and Lori, that's got a lot of potential issues if the wrong decisions are made. So that's even more of a reason why you need to work with us here at America's Retirement Headquarters to make sure that all the bases are covered.
And you could start that process by reaching out and giving a call, 419-794-3030. I'm hesitant to do this, but I feel like I should give credit where credit is due. The government, specifically the IRS, they are very clever in knowing the power in being able to wait. They're counting on you to not do anything and just go with the status quo. So in the form of RMDs, they're going to get their fair share. Perhaps some would say more than their fair share. If it is an IRA that's passed on to a loved one, getting their cut as well there. It's not to say that there aren't ways to minimize that, but you just have to be aware of that. And that is something with the tax roadmap, with the retirement team action plan. The guys at America's Retirement Headquarters can show you how to minimize the amount that you and your loved ones have to give to the IRS. Obviously, pay what you're obligated to, not a penny more. It all begins with that tax roadmap. To receive that, again, 419-794-3030, or you can go to the website, which is arhq.com.